Whether you're filling up your car or just buying a cup of coffee, you've probably noticed how prices can swing wildly. It's unpredictable. But what if there was a way for businesses to protect themselves from all that chaos? Well, there is. And today, we're going to pull back the curtain on this really powerful financial tool that helps bring some certainty to a super uncertain world. It's called the futures contract.
So, to really get a grip on how this all works, let's just start with a super simple story. It kind of gets to the very heart of the problem. Let's talk about a farmer.
Okay, so picture this. Our farmer, she's out there in the spring planting her wheat. She's pouring in all this time, money, and hard work. But here's the catch. She won't actually sell that wheat for months. And that creates this massive question mark, right? How on earth can she know, or better yet, guarantee that she'll get a decent price when harvest time finally rolls around?
I mean, the stakes here are just incredibly high. Think about it. In all those months between planting and harvesting, the global price of wheat could totally crash. A really bad price swing could literally wipe out her entire year's profit. All that work, just gone, for nothing. That right there is the core problem, price uncertainty.
So you're probably asking, how do you fight back against a future you can't predict? Well, the answer is a really cool concept called hedging, and you can seriously think of it like a financial shield you hold up against all that market craziness.
So what is a hedge, really? It's basically any move you make to lower your risk. And this is key. The goal isn't to get rich quick. It's to protect what you already have. The best way to think about it is like insurance. You pay a little bit now to make sure you don't face a total disaster down the road. It's all about playing defense.
Okay, so the main tool in the toolbox for this kind of financial insurance, it's the futures contract. Let's really dig in and see what makes it tick. All right, a futures contract is pretty much what it sounds like. It's a contract about the future. It's a rock-solid legal agreement to buy or sell something. Could be oil, wheat, gold, you name it, at a price you lock in right now for a delivery that's going to happen way down the line. The three magic words here are standardized, predetermined price, and future date. Now, you might hear about something called a forward contract, which is kind of like the private, custom-made cousin of a futures contract. With a forward, two people can cook up any deal they want. But that flexibility has a huge downside. What if the other person just doesn't follow through? That's a real risk. Futures contracts are different. They're traded on a big, public exchange, they're standardized, and they're guaranteed by a clearinghouse. All that means they're way safer and much, much easier to buy and sell.
Let's make this even more real with another example. Say you're an oil company, and you know that in 1 year, you're going to have 1 million barrels of oil ready to sell. Today, the price is awesome. Let's say $78 a barrel. But you're nervous it might drop. So what do? You sell futures contracts to lock in that sweet $78 price. Now, fast forward a year. Even if the market price is tanked to, say, $50 a barrel, it doesn't matter to you. You still get your guaranteed price. Boom! You've just successfully hedged your risk.
So this brings up a big question. If our farmer or oil company is trying to get rid of their risk, who in the world is taking it? Well, this whole market works because of two very different groups of people with totally opposite goals. You've got your hedgers and you've got your speculators. First up, the hedgers. These are the folks we've been talking about, the farmers, the miners, the airlines that need to buy jet fuel. Their number one goal is just to eliminate surprises. They're dealing with a real physical thing, and for them, futures contracts are just a smart business tool to bring some stability to their world. And then you have the speculators. These are the traders, the hedge funds, the investors. Let's be clear, they have zero interest in getting 1,000 barrels of oil delivered to their doorstep. Their only goal is to make money by betting on which way the price will go. They are the ones who willingly step in and say, I'll take that risk you don't want. And as weird as it sounds, the market absolutely needs them. Without speculators, there'd be no one to take the other side of the bet, and the whole system would grind to a halt. They provide the liquidity that makes it all work. All right, let's take everything we've just learned and apply it to one of the biggest, most fascinating markets on the planet, gold. You're going to see the exact same dance between hedgers and speculators, but now we're talking about an absolutely massive scale. So here's the thing about the gold market. It never sleeps. It's not in one building on Wall Street. It's a global 24-hour-a-day network. And at the center of it all are these huge international banks called bullion banks. They're the ones making the whole thing go, helping everyone from miners to jewelers manage their risk literally around the clock.
And trust me, this isn't just numbers on a screen. The demand for actual physical gold is huge. Just take a look at a country like Indonesia.
People there are buying tons of gold every single year for things like jewelry and just as a safe place to put their money. And every single one of those transactions creates a price risk that someone somewhere needs to manage.
And if you really want your mind blown, just look at this number. That's almost $24 billion. That's how much gold gets traded through the London market alone, every single day. It's a truly staggering amount of money, and all of that value needs protection from risk.
Okay, so we've talked about farmers, oil producers, the massive gold market. What's the big takeaway here? What's the one thing you should remember from all this? Here's the most important thing to get. Futures markets are not a crystal ball. They don't predict the future. Nobody knows if the price of wheat is going up or down. What they do provide is an incredibly powerful tool. They're a mechanism that lets the people who actually produce and use all this stuff, all these vital commodities, hand off their risk to someone else who's willing to take it. It's all about bringing a little bit of calm to a very unpredictable world.
But that leads us to one last really big question. We've built this amazing, complex system to help manage risk, but in doing so, could we be creating brand new risks, maybe even bigger ones we don't fully understand yet? It's definitely something to think about.